Welcome back to the deep dive. Today, we're really diving into something well, it's stirred up a lot of debate in the crypto space, the Pi network.
Yeah, it's definitely one of those projects people have strong feelings about.
Absolutely. And if you've been tracking it, or maybe you're one of the, millions of users, you'll know that period after the open mainnet launch. The market action.
Wow.
Brutal is probably the right word.
It really is. We're looking at some serious volatility. First, there's that huge spike, right? A real wave of market excitement pushed the token price up to around $3.
That initial euphoria, yeah. People thought, here we go.
And then it just completely turned. We saw this devastating months-long slide. I think the term is propad.
That's the one, yeah. A continuous grinding decline.
And it wasn't small. We're talking a collapse of over 90%. It bottomed out somewhere near, 20 cents? Just painful.
Absolutely painful. And to anyone just looking at the chart, it screams, pump and dump, right? You're just, total market failure, wiped out huge amounts of value. Exactly. That's the standard interpretation. But, and this is why we're doing this deep dive, the source material we've gathered, it paints a very different picture, a really audacious one, actually.
A controversial one, definitely.
Yeah. There's this detailed analysis doing the rounds in the Pi community, and it claims that crash, that devastating drop, it wasn't a mistake. It wasn't failure.
It claims it was deliberate. A strategy.
A deliberate strategy. Calculated, painful, yes, but supposedly necessary. A transition.
And that's really the core mission for us today, isn't it? We need to unpack this theory, this idea that the massive collapse was actually engineered.
Right, engineered to move away from what the analysis calls market anarchy.
Yeah, the claim is the crash was basically needed to reset everything, to pave the way for something completely new. A centrally managed, almost institutionally controlled economy. They even give it a name.
Which is pretty provocative in itself.
Very. They call it Pi-Keynesianism.
Okay, Pi-Keynesianism. We'll definitely need to break that down.
Absolutely. We need to explore the mechanics they think are involved. Like, why would the PiCore team, the PCT, supposedly allow all that pain? What tools are they supposedly building for this central control?
And crucially, does this whole theory actually hold water? Or is it just, a way to explain away mass disappointment?
That's the critical question.
Okay, before we really get into the weeds of the economics and the tech, we absolutely have to put up a big flashing warning sign here. This is crucial.
Mandatory, really, given how speculative this all is.
Exactly. This whole idea, the deliberate collapse, the specific strategies we're about to talk about, this is all coming from community interpretation and analysis from the community.
It is nowhere officially confirmed. The PiCore team hasn't said, yes, this is our master plan. Not at all.
We're not endorsing this theory. We're not saying it's true. We are examining it, looking at the evidence they claim supports it, and also looking at the counter-arguments. We want you, the listener, to have the full picture, all the different viewpoints on this really complex situation.
Right. Objectivity is key here.
Okay, so let's start with what we do know for sure, the market history. Because that initial pain, that crash, it's the bedrock this whole theory is built on.
It is. The source material definitely highlights that spike to $3, but the focus is really on the long, drawn-out crash afterwards.
Losing over 90% of value, that's just catastrophic by any measure.
And it wasn't just the price. The analysis points out that trading volume also just evaporated, a 96% decrease, reportedly.
Wow, 96%. That's not just a correction. It's like the market just losing all interest, all liquidity, just drying up.
Exactly. It signals a severe crisis of confidence.
And according to this theory, that chaos, that massive market bleed out. That's why the PCT supposedly decided to completely reject the standard crypto path, the Bitcoin path.
That's the argument. They looked at the history of crypto, especially Bitcoin, which is really built on this laissez-faire idea, right?
Laissez-faire, like let it be, hands off.
Pretty much. No central control. Bitcoin's price is just raw supply and demand playing out in a decentralized way. Pure market forces.
Which sounds great in theory, pure freedom.
Yeah.
But in practice?
In practice, it means wild swings, massive volatility. We saw it in 2017, 2021. It's chaotic. You get these huge pumps followed by devastating dumps. It's driven by speculation.
And it can wipe people out overnight.
Completely. So the Pi analysis argues the PCT looked at all that chaos, that reliance on pure speculation, and basically said, this doesn't work for us.
Why not? Because their goal wasn't just price.
Apparently not. Their stated goal has always been about utility, right? Building this massive ecosystem with dApps, real-world uses.
Like a digital economy.
Exactly. And if you're trying to build, say, an alternative to Amazon or payment system, you can't have your main currency, your token, jumping up and down 20% in a day.
Right. Businesses need stability, predictable costs.
Hmm.
People need to know what something's worth when they buy or sell it.
Volatility kills utility. So the theory goes, the PCT made a conscious choice: stability and control over the wild ride of speculative price discovery.
Okay, so if they're rejecting the Bitcoin model, the decentralized, potentially chaotic model, what are they moving towards? The analysis makes a really interesting comparison here.
It does. It puts Pi closer to something like Ripple, XRP, or maybe even, and this is a big one, central bank digital currencies, CBDCs.
Whoa, okay. Ripple, I can maybe see the parallel with a large controlling entity, but CBDCs, that's comparing a community crypto project to like government-issued digital money. That's a huge leap.
It's a radical comparison, absolutely, but it fits the narrative of central control. Think about Ripple Labs. They hold a massive amount of XRP in their treasury.
And they sell it off periodically to fund operations, right?
Right. They sell it strategically. And they've often been accused by parts of the XRP community of suppressing the price because their priority is stability for their banking partners, not necessarily maximizing short-term gains for retail holders.
Okay, I see the parallel there.
Yeah.
A central entity managing supply for strategic goals.
The analysis suggests Pi is kind of aiming for a similar outcome, but maybe trying to build a more formal, perhaps more transparent system for managing that intervention. Basically embracing the role of a corporate central planner for their ecosystem.
And the source material actually throws in something else here, doesn't it? Something about past attempts at control, though it sounds a bit murky.
Yeah, this is a really explosive claim in the analysis, and importantly, it's flagged as unverified. We have to stress that.
Unverified claim. Got it. What is it?
The analysis alleges that the PCT had actually tried to intervene in the market before, but clumsily, that they supposedly dumped Pi tokens onto external exchanges in these short bursts, like 7 to 21-day cycles.
Dump tokens.
Yeah,
To try and control the price.
that's the allegation. Again, no solid proof provided in the source for this, but if it happened, it would suggest they recognized the need for control early on, but didn't have the right tools.
Which, in the context of this theory, would then lead them to say, okay, these clumsy interventions aren't working. We need something built in, something systemic.
Precisely. It serves the narrative. It suggests they saw the chaos, tried clumsy fixes, failed, and then decided, right, we need to let the market burn while we build the real control mechanism.
Which means letting it crash to buy time. Okay, that sets up the next part perfectly. The core strategy, this supposed Pi Keynesianism.
So if you buy into the logic of this community analysis, that brutal market bleeding, the 90% drop, wasn't an accident. It wasn't neglect.
It was calculated.
Calculated. The PCT supposedly let the price tank for one main strategic reason. They needed time. And maybe more importantly, they needed data on user behavior during that stress.
Time and data to build the tool that would stop this kind of chaos from happening again.
That's the idea, to build the mechanism to protect their dApp economy vision.
And that mechanism is the AMM, the auto market maker. Now, for people maybe less deep in DeFi, an AMM is usually just part of a decentralized exchange, right? Like Uniswap uses them.
Typically, yes, it's infrastructure. It uses algorithms and liquidity pools to let people trade without traditional order books. Pretty standard stuff in DeFi.
So why is the Pi AMM supposedly so different? Why is it framed as this central policy tool?
Because, according to this theory, it's built with a totally different purpose. A normal AMM is passive. It just executes trades based on the math of the liquidity pools. It doesn't have opinions.
Okay.
But the Pi AMM, as described in this analysis, isn't just infrastructure. It's designed to be the primary active instrument of monetary policy for the whole Pi ecosystem.
Monetary policy, what a central bank does.
Exactly like that. In normal DeFi, the core team usually steps back after launch. But the claim here is the PCT wants to be the primary market maker. They intend to actively manage the market.
How? By using their treasury?
Yes, by intervening with treasury assets, by setting specific rules and incentives within the AMM, controlling volatility, not just letting the market figure things out on its own.
Okay, let's circle back to that term you mentioned, Pi Keynesianism.
Yeah.
It obviously references John Maynard Keynes, the economist. His big idea was about government intervention, right?
Yeah, Keynes argued that free markets aren't always self-correcting. They can get stuck in bad places, like depressions. So he advocated for active government intervention spending, tax policies to manage the economy, smooth out the booms and busts.
So how does that apply to Pi? Who's the government here?
PCT is, effectively. They hold the treasury, the central supply of Pi. The Pi-Keynesian idea is that they see it as their job to actively intervene using the AMM and their treasury funds to ensure the stability and health of the Pi economy.
So the crash. That was the crisis that forced their hand.
According to the analysis, yes, it was the baptism by fire. It supposedly proved to them that just letting the market run wild, laissez-faire style would kill their dream of a utility-based DApp ecosystem. So they had to step up and become the central planners.
Even if that means ditching some core crypto principles of decentralization.
Apparently so.
Yeah.
They're prioritizing managed stability over decentralized chaos, if this theory is correct.
You also mentioned their fear wasn't necessarily a low price, but volatility. Why is a volatile $1 token worse for them than, say, a stable 20-cent token?
Think about usability. If you're a developer building an app on Pi, maybe selling digital goods or services, if the Pi token is worth $1 today, 0.50 cents tomorrow, and $1.50 a week, how do you price anything?
Yeah, it's impossible. Your revenue in real-world terms would be all over the place.
Exactly. Customers wouldn't know what they're paying, businesses couldn't plan. That kind of volatility makes it useless as a medium of exchange for everyday transactions.
But a stable 20 cents.
The stable 20 cents, while maybe disappointing for speculators hoping for a moonshot, is actually functional. Developers can set prices like, this costs 10 Pi, and everyone knows that's roughly $2 consistently. It allows an actual economy to function.
So the alleged decision to let it crash was about sacrificing that immediate speculative hype for long-term, boring, stable utility.
That's the core argument. A stable currency, even at a lower value, is better for building their planned ecosystem than a wildly fluctuating speculative asset.
Okay, so the really big picture takeaway here, if we follow this controversial line of thought, is pretty fundamental. Pi Network isn't trying to be Bitcoin 2.0.
Not at all, according to this analysis. They're not aiming for a faster Ethereum either.
They're trying to build something else entirely. The first corporate, centrally managed digital economy at a massive scale. Is that fair?
That's the claim. It's about deliberate management, controlled growth, suppressing wild speculation, all orchestrated by the core team. It really does flip the usual crypto narrative on its head.
All right, so if the PCT is going to be this central planner, this digital Keynesian manager, they first need to know who they're managing, right? The analysis claims they had to figure out if their users were truly committed citizens or just short-term mercenaries.
Yeah, that's a key step in the alleged strategy. Before you impose potentially tough controls, you need to know if your base will stick with you. This led to what the source calls a genial social experiment.
Genial sounds nice, but what did it involve?
It involved establishing what they called the Pi standard. And the core of it was asking users to do something pretty unusual in crypto: staking without profit.
Staking without profit. So, locking up your coins, but getting nothing back for it. No interest, no rewards.
Exactly. Usually, staking is how you earn yield in DeFi.
Yeah.
You lock your tokens, you get rewarded. Pi allegedly asked users to lock up a significant chunk of their mine Pi for potentially long periods, purely as a show of commitment to the ecosystem. No financial gain attached.
Wow, that's a big ask. Why would anyone do that?
Well, the analysis argues it was a filter. Anyone willing to sacrifice liquidity, to give up the chance to sell quickly just to support the network. They weren't just in it for a quick buck.
They were demonstrating belief, seeing Pi as more than just money.
That's the idea, proving they were true believers. Part of the long-term vision, not just flippers waiting to dump. It's a kind of behavioral test of loyalty.
A clever psychological mechanism, if that was the intent. Did it work? Does the analysis say how many people did this?
It does, and this is where we hit a really critical data point, or maybe a critical problem with the data point. The analysis claims this loyalty test was a huge success, stating that 600 million Pi were locked under these zero reward conditions.
600 million? That sounds like a lot.
Yeah.
That would be a massive chunk of the circulating supply, wouldn't it?
It would be enormous. And if true, it would absolutely signal incredible community buy-in. It would give the PCT the mandate, the social license to then implement their more controlling AMM policies.
Okay, but you said there's a problem with this number. This is the critical data check we need to highlight.
Absolutely essential. We have to pause here. The source material itself flags the 600 million figure as unconfirmed. There's no clear independent verification for it.
Unconfirmed, okay.
And worse, the analysis acknowledges that this number, or one very close to it, has also been floating around the community in a completely different context.
What context?
In relation to massive token unlocking events, specifically unlocks scheduled for potentially July 2025.
Wait, unlocking is the opposite of locking, right? Unlocking increases supply pressure, potentially crashing the price. Locking reduces it.
Exactly. It's a fundamental difference. If the analysis is confusing data about future unlocks, bad for price stability, with data about past loyalty locks, good for perceived stability, that's a major red flag.
That could undermine the entire premise that they proved community loyalty before acting.
It seriously weakens that specific argument. Plus, we know from other reports that this whole staking without profit thing wasn't universally popular. The source mentions it caused considerable confusion and criticism, so painting it as a universally accepted proof of loyalty might be stretching it.
Okay, so that's a really important caveat on the whole Pi standard loyalty test. But let's assume, for the sake of following the theory, that the PCT felt they did have enough loyalists. What's the next step? Implementing the control mechanism.
Right. Implementing the central tool, the custom auto market maker. Now we get into the proposed mechanics of how this AMM would allow for differentiated incentive.
Differentiated incentives, meaning treating different types of trading differently, unlike a standard DAX like Uniswap.
Precisely. Standard AMMs are neutral. They apply the same fee structure, the same logic to every trading pair. Whether it's a major pair like Ether USDC or some tiny niche token, they're permissionless and uniform.
But Pi's AMM allegedly wouldn't be neutral.
No. The theory is the PCT will use its treasury and its control over the AMM's code to actively reward certain behaviors and penalize others. It acts more like a regulator than just a neutral exchange formula.
Okay, how? The analysis mentions a carrot and stick approach, right? Plan A and Plan B.
Yeah, classic framing. Let's start with the carrot.
Plan A, the ecosystem subsidy. What's the carrot?
The analysis claims the PCT plans to massively subsidize specific liquidity pools, the ones they see as beneficial for the ecosystem's health.
Which ones are those?
Specifically, PiDApps pools. So pools where you swap Pi for tokens related to actual applications running on the network, or maybe for in-app services.
How would they subsidize them? Just give extra rewards to people who provide liquidity there.
Exactly. Using the PCT's treasury to shower those pools with extra Pi rewards. It's a way to direct capital. If you make it super profitable to provide liquidity for using dApps, you encourage people to do just that.
So you're essentially paying people to support the utility side of the economy, not just the speculative trading side. It's like an economic stimulus for internal commerce.
That's a good way to put it. Engineering the market to prioritize actual use cases.
Okay, that's the carrot. Now for the stick. Plan B. The speculative tax. This sounds like where the control really bites.
This is the enforcement mechanism, according to the theory. The Pi economy still needs to connect to the outside world, right? People need to be able to cash out or maybe bring outside money in.
Through stable coins, usually. Like USDC or Tether.
Exactly. So you need PiUSDC or PiUSDT pools. These are the essential bridges. But they're also the bridges that pure speculators would use to jump in and out, potentially causing volatility.
So the PCT doesn't like these bridges.
The theory says they will be intentionally punished, made less attractive to use.
Punish now.
The main suggestion is through significantly higher transaction fees. The analysis throws out an example like a 1% fee on trades in these stablecoin pools.
1%. Wow. Most equities are like 0.3% or even 0.1%, aren't they?
Yeah, 1% is huge in the world of automated trading. It makes a massive difference to profitability.
How does that function as a tax on exit then?
Well, think about arbitrage traders or high-frequency speculators. Their strategies often rely on making tiny profits on many, many trades. If the cost of swapping Pi for USDC and vice versa is suddenly 10 times higher than on other platforms,
It kills their profit margins, makes it not worth doing.
precisely, it renders many short-term speculative strategies completely unviable. And to add insult to injury, the analysis suggests these punished pools will also receive zero extra rewards for providing liquidity.
So you pay a high fee and you get no bonus for helping.
Right. It's designed to be financially unattractive. It creates friction. It's like a financial wall, discouraging people from treating Pi purely as a speculative asset to be flipped for stablecoins. It tries to herd activity towards those subsidized dApp pools instead.
That is definitely a form of capital control, digitally enforced. Wow.
It's top-down economic management applied via AMM design.
And there's one more piece to this AMM strategy, something about directly managing volatility.
Yes, the AMM as a volatility damper. This is where the direct intervention comes in, using the Treasury.
The Keynesian part.
The most explicitly Keynesian part. The PCT's Treasury acts like a central bank's reserves. If, despite the fees, speculators manage to pump the price of pi up too quickly.
The AMM steps in.
The AMM, controlled by the PCT, would supposedly inject liquidity from the Treasury, flood the market with more pi to absorb that buying pressure and push the price back down, preventing a crazy spike.
Okay, and if the price starts crashing?
Same logic, reversed. If there's a panic sell-off, the AMM would withdraw liquidity. Essentially, use Treasury assets, like maybe stablecoins they hold or just burning pi, to buy up pi, soak up the selling pressure, and try to establish a price floor.
So they're actively leaning against the wind, selling into pumps, buying into dumps, using the Treasury to smooth out the peaks and troughs.
So that's the theory, micromanaging market movements, aiming for stability, using open market operations, but within their own ecosystem.
It's a fascinating, if highly interventionist model. But again, we have to end this section with that crucial reality check.
Absolutely. The fees, the subsidies, the direct buying and selling by the AMM, this is all speculation about the future.
Because the AMM is only on the testnet right now.
Correct. None of this is live and proven on the main network. We are analyzing a proposed or theorized strategy based on community analysis of testnet features and PCT communications. We are not describing a system that is currently operational in the wild.
Very important distinction.
Okay, so we've laid out this intricate theory. The deliberate crash, the pi Keynesianism, the sophisticated AMM controls. It's quite a narrative.
It really is, and you can see why it might appeal to people who experienced that crash. It reframes loss as part of a master plan.
Exactly. It offers meaning.
Yep.
But our job here is to be critical, to weigh this complex, intention-driven theory against simpler explanations. Because usually in markets, the simplest explanation is often the right one.
Occam's razor.
Pretty much. So before we dive into the alternative explanations for the crash, let's quickly recap what we actually know are verified facts about Pi Network, just to anchor ourselves.
Good idea. What's the solid ground?
Okay, verified. Pi Network, founded by Stanford PhDs back in 2019. Their core idea was always about making crypto accessible, easy phone mining. Just press a button, daily, ecological focus.
Right, low energy consumption compared to Bitcoin mining.
And their stated goal has consistently been building an ecosystem around dApps and real utility. We also know they have developed their own decentralized exchange, DEX, and an auto market maker, AMM.
But crucially,
those are currently on the testnet. They are not fully deployed and operational on the live open mainnet yet. Those are the established facts we can work with.
Okay, so grounded in that reality, let's attack the core premise of the theory, that the 90% crash had to be deliberate. What are the boring, standard market-based reasons why a new crypto project might crash that hard? The analysis itself must acknowledge these, right?
Oh, absolutely. Any credible analysis would have to. And there are several very plausible, non-conspiratorial reasons. Let's list maybe the top 5.
Try for it. Number 1.
The most common one in crypto history. Natural decline after hype wears off, especially when utility isn't there yet. Projects launch with huge promises, attract tons of speculative money.
And then the mainnet opens, the killer app isn't quite ready, and the speculators just leave.
Exactly. The hype cycle peaks, reality sets in, and the price corrects, often dramatically. Happens all the time.
Okay, makes sense. Number 2.
This one's huge for Pi, given its mining model. Massive token unlocking. Think about all the Pi mined by millions of users over years. When those tokens finally become transferable, sellable.
Suddenly, there's this enormous wave of supply hitting the market. People who got it essentially for free might be happy to sell at almost any price.
Precisely. That kind of supply shock, especially into a market that probably didn't have deep liquidity yet, can absolutely crush the price. No need for a deliberate PCP plan. It's just market mechanics.
Right. Number 3.
User patience. Or rather, impatience. Disappointment due to slow ecosystem development. Pi has been around since 2019. That's a long time in crypto.
People might have expected the dApps, the utility, to roll out faster after the mainnet opened.
If the perception was that development was too slow, that the promised utility economy wasn't materializing quickly enough, frustrated holders would sell. Simple as that, adding to the downward pressure.
Okay. Number 4. This one's about the wider market.
Yeah, lack of listings on major top-tier exchanges. Think Binance, Coinbase, Kraken. Getting listed there brings 2 vital things.
Liquidity and legitimacy.
Massive liquidity, yeah. And access to a much larger pool of capital, including institutional money. Without those top-tier listings, Pi would be mainly trading on smaller exchanges.
Which means lower volume, thinner order books. Much easier for prices to drop sharply on relatively small sell orders.
Exactly. The market is just less robust, more susceptible to swings.
Okay, and the fifth alternative explanation. The catch-all.
It's simply the usual, predictable cycle for most new crypto projects. Seriously, look at the charts for thousands of altcoins, hype phase, massive pump, brutal crash, long period of consolidation or slow bleeding. It's almost a rite of passage.
The crypto winter effect for individual projects.
Yeah. So when you bundle these 5 factors together, post-hype decline, huge token unlocks, slow development perception, lack of major exchange listings, and just the normal altcoin cycle, do you really need a complex theory about deliberate manipulation?
Probably not. These 5 seem perfectly capable of explaining a 90% drop on their own.
It's certainly the more conventional and arguably more probable explanation.
Okay, so those are the strong counterarguments based on typical market behavior. Let's also quickly recap the specific structural flaws within the deliberate crash theory itself, the ones highlighted in the source material we looked at, the weak links in their own argument.
Right. 4 main ones we should reiterate. First, and most fundamentally, no direct proof of PCT intent. It's all inference. We're seeing market outcomes and assigning a strategic motive after the fact. That's always risky.
We don't have the internal emails or meeting minutes saying, let's crash the market.
Exactly. It's interpretation, not evidence of intent. Second, that data issue we hammered on. The 600 million locked token figure is unverified and potentially confused with unlocking data.
Which weakens the whole proof of loyalty foundation for the strategy.
Massively. Third, the historical bit. Missing sources for those alleged prior clumsy PCT selling cycles. The theory uses this claim to justify why they needed the sophisticated AMM, but provides no proof the clumsy selling actually happened.
So it's an unsubstantiated premise.
Feels like narrative filler without backup. And fourth, tying back to our alternative explanations. The simplest explanation, market forces, is usually more likely than a complex, multi-stage manipulation strategy. Occam's razor again.
So while the Pi Keynesianism idea is intellectually stimulating,
intellectual honesty pushes us towards the more straightforward market dynamics as the primary driver of the crash.
well, this has been quite the journey. We've navigated the verifiable chaos of that Pi market crash, the brutal 90% drop.
And contrasted it with this really elaborate, almost elegant theory of deliberate, strategic control.
Yeah, this idea of a team intentionally causing pain to build a foundation for long-term managed stability. It's a fascinating dichotomy.
It really is. And, regardless of whether the specific community interpretation, the deliberate crash narrative turns out to be accurate or not, the approach Pi Network seems to be taking is undeniably interesting.
How so?
Because it represents a genuine experiment. The vast majority of the crypto world, historically, has followed the path laid out by Bitcoin and Ethereum. Decentralization, permissionless systems, letting the market sort things out.
The laissez-faire approach.
Right. Pi seems to be consciously diverging from that. They appear to be betting on a different model. Centralized management by a core team, a community-first ethos, but guided from the top, enforced using custom-built tools like their AMM.
Trying to tame the chaos of crypto through deliberate intervention.
Exactly. Trying to escape that inherent instability, that speculative frenzy, by imposing order. Whether you agree with it or not, that ambition to build a massive digital economy that is actively governed makes Pi fundamentally different.
It definitely sets it apart and makes it worth watching, regardless of the price charts.
For anyone interested in how economic models might evolve in the digital age, yes, absolutely.
So, for you, the listener, who's stuck with us through all this complexity,
Yeah.
what's the final takeaway? Our advice?
I think the main thing is to maintain critical distance. Remember, the narrative of a deliberate crash of Pi Keynesianism, it's a compelling story. It provides rationale, but it remains, as of now, a speculative community analysis.
Not verified fact.
Not verified fact. So if you're making decisions about engaging with Pi or investing time or resources, base those decisions on verifiable information.
Like what?
Like the actual pace of dApp development you can see. The real confirmed functionality of their AMM when or if it hits the mainnet. The official tokenomics, the actual unlocking schedules. tangible things.
Not just compelling theories, however neat they sound.
Exactly. Don't base decisions on elegant community narratives built to explain past pain. Stick to the facts you can confirm.
Okay. And maybe a final thought to leave people mulling over. Something provocative.
Well, I think the whole Pi experiment, this attempt to build a huge corporate-managed digital economy, it really forces us to ask a fundamental question about the future of digital assets and maybe even governance itself. Can a centrally planned monetary system, even a sophisticated digital one, truly achieve long-term stability and credibility in a world that increasingly values decentralization? Or will the raw, often messy forces of the free market always find a way to overwhelm even the cleverest central planning?
Central control versus market freedom, playing out in real time within a crypto ecosystem.
That's the grand experiment, isn't it? We're all watching to see which force ultimately prevails. It's going to be fascinating to see how it unfolds.